Hey, Bulls and Bears, how's everybody doing? You're watching Bull Boom, Bear Bust, and we're back with another dose of economic reality. We have some huge news to get into today, as usual. Pretty much every report, there's huge news when it comes to what's happening in our world, our economy, our financial sector here. The layoffs, the de-dollarization, the cost of living crisis, the late payments, the people that can't pay their rent. It's just it's mind-boggling how much news every day that I really should report on. Now I missed my report yesterday, so I'm going to go a couple extra minutes today, a couple extra minutes longer than usual. But let's start off right here. Now we all know that the U.S., the world's largest debtor nation, that's just the opposite of what we've been told. We've been told that we're the world's richest nation. And that's because when you have the capability of taking on endless amounts of debt, then it creates the illusion of wealth, right? So if you could have an unlimited credit card and you never had to actually worry about paying it back, imagine how much richer and wealthier you would look, right? You'd have the nicest car, you'd have the nicest home, probably homes, cars, multiple, because unlimited debt, unlimited credit. The flip side of credit is debt. So it's no coincidence that the United States, a country here with the world reserve currency, is also the world's largest debtor nation. But we've been told we're the world's richest nation. So you see right through that scam, right? You see right through that. Now, what's been happening, even allies of the United States, countries that are allies or, quote, friendly to the United States, are getting away from the U.S. dollar. Here's a report here today. Global reserves held in U.S. dollars fell to less than 50%, and officials from other countries are calling it a toxic currency. A toxic currency. Some of these countries are our allies, but even our allies see what is happening, right? So go all the way back to the Bretton Woods Agreement back in the 1940s, the establishment in the 70s of the U.S. petrodollar, coming off the gold standard in the 71 rather. All these things led to this boom in the United States, or what looked like a boom. Right? Our standard of living was very high. Now, not for everybody. There's still a lot of poverty. But when you have endless amounts of debt, you can actually have this big safety net for people, even for people that don't work, for example. So it created this very high standard of living. But you and I, we're about to witness historic events. We're about ready to witness history. So this is a very interesting time to be alive. And what's headed our way here is going to be biblical. It's going to be something we're going to be telling our generations to come. We're going to be talking about this here, in my opinion. But it's not just me saying this. Take a look at some of these numbers here. Global central banks are beginning to diversify their reserves away from U.S. dollars. Now, this comes at the same time as a lot of central banks have been stacking precious metals, gold and silver. Record purchases last year. If I'm not mistaken, I believe it was about a 40-year high last year. I don't have the chart in front of me, but it's multi-decade high. Let's put it like that. But here's what happened here to the U.S. dollar just in the past couple years. In 2021, U.S. dollars represented 55% of all reserves held globally for central banks. That dropped from 55% to 47% in 2022. That's a big drop, folks. That's 8% in 1 year. At this pace, we're only looking at a few more years before the U.S. dollar's toilet paper, like some of these other countries, Venezuela, Zimbabwe, Weimar Germany. I mean, pick your hyperinflationary scenario. Pick your point in history where these other fiat currencies have become worthless, basically. So 8% from 2021 to 2022. We haven't seen the 2023 numbers yet. It could be accelerated. What's it going to be? Is it going to be 10%? Is it going to be another 12% drop? So is it going to go from 47% down to 37%? Is it going to be another 10% drop? I don't know, but it was 8% from 2021 to 2022. So a 10 to 12% drop really wouldn't be very surprising to me. Anyway, would it be surprising to you? Please let me know what you think down in the comments. And if it is 10% in 2023, we're only looking at a few more years, again, before the dollar turns into toilet paper, right? So pretty interesting times, pretty scary times. And we see that they're out there raising rates right now in an attempt to keep this dollar system going. Will they be successful? Well, they haven't been successful in really stopping inflation. In fact, nobody's even talking about stopping inflation. All they're trying to do is slow down inflation. They're trying to get it back to 2%, which is the inflation target, which is ridiculous. If you're bleeding, let's say you have a wound, you have an injury, and you're bleeding. Do you want to stop the bleeding? Okay, I think that's what most people would want to do. They want to stop the bleeding. Well, the Fed's not trying to stop the bleeding. They're trying to slow down the bleeding. Instead of 6% inflation or 5.5 or whatever it's been, they're trying to get it down to 2%. That's not stopping the bleeding. That's just slowing down the 2% inflation means prices are still going up 2% a year, which is too much. Right now we need deflation. But again, nobody's talking about deflation. No officials anyway. Of course, people like you and me are talking about the possibility of deflation. And we're seeing that in a couple different areas, unless you have to finance something, and then there's no deflation at all. If you have cash, then yes, homes are a little cheaper than they were. Automobiles a little cheaper than they were. If you have to finance, because of the rates now being higher, you're still seeing higher costs for these carrying these items, these assets. Oh, real quick before I forget, yesterday I was really tired, so I didn't put out a video. I had to get rest. I'm on 2 months now without coffee, and I've been feeling a little better, but today I cheated a little bit. Look what I found here. This is a coffee infused cereal. I got this for 99 cents at some discount store, so I figured I would give it a try. Chamberlain coffee cereal, vegan, gluten-free, naturally flavored, non-GMO, right? So it's pretty good stuff there. They actually put real coffee grinds in there. And so it's giving me a little bit of a kick here. So 2 months without coffee, but today I cheated and had this coffee cereal. I couldn't resist. So I'm feeling pretty good right now with a little bit of a caffeine kick. But it's not equivalent to a cup of coffee as far as like this bowl of cereal. So it's not anything too crazy. Now, I mentioned home prices just a few minutes ago. Let's talk about what's happening in the mortgage lending division here. We've got this new implementation of basically a punishment for people with good credit scores. Now, people with high credit scores, 740 plus, are going to be basically paying more for their mortgage to help people with lower credit scores, right? So we're punishing the good credit scores to help subprime borrowers, and this is a bad move here, and it's making something bad worse with housing. I told you they're going to come out with new and creative ways to try to keep these bubbles inflated. And even with higher mortgage rates, a lot of people expected home prices to come down a lot faster than they are. But now things like this, things like the buyer incentive program here in California, that all the funds got wiped out in less than 2 weeks because it gave people a down payment or assisted people a down payment on their home. So obviously people were desperate for that. That's why it was wiped out in just a couple weeks. Programs like this, under the new rules, high credit score borrowers with scores ranging from 680 plus will see a spike in their mortgage costs, with applicants who place 15 to 20% down payments experiencing the biggest increase in fees. So another attempt to keep the housing bubble inflated, and this is your answer, folks. Not just this, but this and other things like this. This is your answer to why you haven't seen home prices correct faster. And I predicted exactly this. I predicted a slow motion collapse or slow motion decline, no crash, no bursting of the bubble, because things like this. And we saw things similar to this back before the previous housing bubble. So it's not a coincidence. Things like this come out at a time when the market is turning, at this peaking point where we're starting to see prices drop. They try to come out with these new little tricks and shenanigans, to get more people into the housing market, which is pretty sad. You're tricking, or you're opening the doors for subprime people to come in at a time when home prices are already falling. And yes, home prices will still fall. I don't think they're going to crash, but not a good time to be, inviting subprime borrowers into the housing market, so to speak. Very, very dangerous. And we had Steph Pomboy put this out on social media. Here's how she breaks it down. This rule to impose fees on homebuyers with high credit scores to subsidize access to lower quality credit is so obviously misguided and dangerous, it makes you wonder what the real objective is here. I mean, we just learned this morning that nationwide home prices are declining for only the second time in U.S. history. And per the Philadelphia Fed, that a deep recession throws many out of work is on the doorstep. And now the time to encourage stretched would-be homeowners to enter the market. It's almost as if they want to drown people in negative equity. That's what it looks like, doesn't it? Or maybe to further, oh, she's using words I don't know, to further innovate the banking system to allow for a larger takeover. I'm honestly lost. And a lot of people are. They're seeing this and they're like, why would they want to encourage people to buy right now? The bubble, is deflating. The absolute wrong time, especially if you're over leveraged, if you're already subprime, would now be a good time to be entering the housing market. It's absolutely ridiculous. And, we have entities out there that are put out there to supposedly help people, to protect people is what they say. Oh, we're the Consumer Protection Agency and all these different agencies, they're hurting people. Their decisions are hurting people. And it makes you wonder, like she said, what's their motive behind this? Why would they do this? Bed Bath & Beyond, finally, after a very long time, we reported over 6 months ago how Bed Bath & Beyond had this liquidation of their bonds. They were trying to raise cash and selling off their stock. And now they're officially bankrupt. They're going to be liquidating their assets, Bed Bath & Bankrupt. No surprise there. We're going to see more high-end retailers fold, go under, while other retailers are going to be popping up, especially ones with lower costs here and lower priced items. Look at Ikea. Ikea is a huge, huge store. I love going there with my family, and the kids love going there so they can jump on all the different beds and look at all the different kids' room setups and bunk beds and stuff like that. Ikea to open new stores in the U.S. with a huge investment. The Swedish furniture company announced plans Thursday to spend more than 2 billion euros, which is about $2.2 billion, to expand in the U.S., the biggest investment in almost 4 decades. Wow. So I think it's because they have a lot of lower priced items there. Things are really, really good priced in there. But if the U.S. sees a depression, will even Ikea be regretting the decision to expand so heavily, into the U.S.? They already have a lot of stores, but they're going to really be expanding even further. John Rubino's out there saying deflation is coming, that falling prices are coming here. Cars and houses are on the list here as far as dropping values or prices. Banks were already tightening lending standards before the failure of Silicon Valley Bank. We have a chart here from the fourth quarter. We show the percentage of U.S. banks tightening lending in 2022. It was already over 45%. And this is pre the 2023 banking crisis. So what's it going to be the next time we look at this report here? It's going to be well over 50%. I mean, it was already about 45%, close to 50% actually, even in 2022. So it's going to be probably 60 to 70% of banks, if I have to guess, are going to be tightening their lending, tightening their credit. And the too big to fail, the mega banks, they can probably still keep on lending like they've been because they have the guaranteed backstop. But will that be enough to make up for all the hundreds and thousands of different regional and local banks that are going to be tightening down their lending and making it harder to get a loan? So Rubino sees it as a deflation in these two categories. We also see bank outflows resumed last week. We talked about that in our last report. Now, the savings rate has been dropping now significantly for over a year. But now add on top of that, more fuel to the fire, so to speak. The banking crisis had more people pull money out of their accounts, not just because they have to pull it out to pay bills because the cost of living is draining their account, but because of fear of these banks, right? So we have a lot of things stacked on top of each other. We have this global de-dollarization happening. So inflation, deflation, a lot of different forces and going in the same direction or that are going to be battling against each other, right? So historic times, we've never seen this. How would you summarize this? Please let me know what you think down in the comments. What would you call this? All these different forces: inflationary, deflationary, inflationary, deflationary, stagflationary. A lot of different things to try to put together and figure out, how to navigate this, right? So we're going to do my best here for you and keep stacking, folks. We're going to stay on top of it so we can stay ahead of the curve here. And again, I'll be reading your comments. Thanks everybody for being here. Talk to you very soon. Bye for now. Peace.